5 dividend stocks to add to your watch list this week if you're not already going to be pulling the trigger on them for the long-term buy and hold. You see, as a dividend investor myself, and likely just preaching to the masses of dividend investors out there, it really doesn't get any easier. So let's get right to them. Now, here we are in the month of October, literally as of this video kicking off into the month. And for all of you who are rather new to investing, historically, October is actually a rather slow month, which I want you to be well aware of instead of this get rich by Tuesday type of energy you might be carrying with you. However, I also want you to bear in mind that we may get a rather bullish October just based on all the macro conditions that have becoming more favorable to all of us consumers, businesses, as well as, of course, investors, me and you, because at the end of the day, with interest rates coming down and inflation, of course, also cooling down, this is all a win-win-win for all of us. Either way, as a dividend investor, you can benefit from doing what we should be doing day in and day out, week in and week out, year over year, just buying high-quality companies at undervalued or even fair prices, a true Warren Buffett-like approach. So let's get to them, with the first dividend stock being Albemarle, ticker symbol ALB, which is a company that develops and manufactures as well as markets specialty chemicals worldwide. Now it operates through 3 segments: energy storage, specialties, and ketgen. But it's actually in their energy storage segment that I want to double down on and focus just a little bit more on with you, because actually, therein lies all of my bullishness, at least in terms of the future when it comes to this stock. Now, it's the world's largest producer of lithium compounds, which are, of course, necessary for batteries, and more specifically, EV batteries. And with lithium being a critical component in EV batteries, which consumed roughly 60% of the mineral's global production just in 2022 alone, the recent electric vehicle slowdown has actually kept lithium prices under pressure and had a significant impact on Albemarle's overall sales volumes and just future outlook. But the question you really have to ask yourself is, where are we going to be in 5 years, 10 years, closer to or further from a greener future? Now, in my opinion, closer to, which puts Albemarle on my watch list at this time, as it's currently trading for just $102 per share. That's down 30% on the year, but click to the 5-year view to actually catch where it was back in 2021 and 2022. Our economic conditions were much better for consumers and businesses, and we see it was trading for over $200 per share. So again, never mind where we are today, just try to understand where we're actually going, because that's what matters. Moreover, scroll down to see the income statement that has depicted healthy flows worth of revenue year in and year out, along with a balance sheet reflecting assets that continue to trump liabilities year over year. However, we are in Albemarle for the dividends, so jumping into Simply Safe Dividends, we're going to get a safe dividend pick here, rated at a 70, with a lower yield coming in at just 1.59%, scrolling down to a payout ratio at 33%, which has allowed it to carry on its 29-year dividend streak. And over the last 20-year period, we've seen a 9% average growth rate in terms of that dividend. Now, personally, I usually target over 10% and over, but sometimes exceptions like this can in fact be made. Again, all comes down to the company and why you're investing into it. Now, if you're looking for an opportunity that may be a bit more in your face on the day-to-day basis, I want you to start to look into Cisco, ticker symbol SYY. As interest rates come down, inflation is cooling, and consumers actually feel a bit more confident to get out there and spend, a company like Cisco is actually likely to benefit as a distributor of various food-related products like cutlery and eatery to the food service or food away from home industry like cafeterias and food courts in the United States, Canada, the UK, France, just all over the world. And we already see it's beginning to actually climb as we speak, nominally up on the year here, trading for $75 per share. Yet I want to click to the 5-year view so you can actually see the power of consumer trend shifts on a pick like this. Now, we've been on the comeback really since COVID. However, scroll down to see the revenue that pours in year over year at $78 billion in 2024. Now, admittedly, I don't love that the balance sheet here is depicting liabilities neck and neck with assets, but the business model keeps me locked in on this one. And as a dividend investor, I'm looking at these dividend metrics, with Cisco coming in at a solid safety score, a dividend yield at 2.71%. Scroll down to see 47% worth of a payout ratio. And again, we're talking about a dividend Cinderella story here, with a 55-year dividend growth streak, as well as a 7% year over year-over-year dividend growth rate. And while we are on the topic of dining out and food, I want to bring Hormel Foods, ticker symbol HRL, to your attention, which is developing, processing, and distributing various meats, nuts, and products all under the sun there under names like Spam, Thick and Easy, Skippy, Valley Fresh, Applegate, and plenty more. If you're actually iffy on this one, I'd encourage you to just walk right over to your pantry or fridge just to see how many products of theirs you're actually already consuming to actually rethink this one, because at its current share price of just $31 per share, it's worth an add to your cart in my opinion. And like the rest of the food processors out there, even to the likes of Pepsi, they have all been beaten down and suffering in our current economic conditions. Scrolling down, we're going to see that revenue just continues to pour in. Of course, balance sheet wise, a company that has been proving itself year over year with assets far exceeding liabilities. But this is why I love Hormel Foods and why you got to consider it as a dividend investor. Across the board, we have a dividend aristocrat on our hands, scoring a 90 on the safety score, coming in at a strong 3.6% dividend yield. And despite the higher payout ratio of 71%, we have been seeing that this one has been trucking right along for the past 58 years in terms of a dividend streak. And as we scroll down, we're going to see that it's bringing in an average growth rate of 12% year over year. But also, this is why I like dividend growth picks, as I personally base all of my investments on my investor profile and looking for more share price appreciation at the token of a smaller yield. However, before I cover the next two dividend stocks, investors, I want to ask that you join me here on this channel by subscribing. Now, we have officially trimmed down the 70% of you watching but not actually subscribed down to 68%. That's huge, and it goes a long way for me. And based on all of my retention analytics, I'm going to let you know that once people find the channel, they stick around. So I need your help in continuing to grow the community, but also tapping the thumbs up button. That lets me know that this is the content you're actually looking for. But with all that said, I want to get back to it here with Becton Dickinson & Co., ticker symbol BDX, which manufactures and sells medical supplies, devices, lab equipment, and diagnostic products to healthcare institutions, physicians, life science researchers, pharmacies, and all on a global scale. Now, that should immediately give away the company's level of investment safety, if you will, as it has ultimately become a dominant name in the industry to the likes of, say, J&J or Medtronic. And of course, with our economic conditions that called for budget restrictions and overall less spending, all of the company's clients have been cutting back, meaning that has hit their bottom line quite hard, resulting in lower earnings and spooking away investors. So now we see it for $238 per share. But 5 years out, which is what really I want to show you, we can paint an interesting trend here with the ebbing and flowing, because just like J&J or Medtronic, I'm not here to say that Becton Dickinson is going to 10x, but I'm going to say it's going to deliver through on reliability like its peers. So it really comes down to the right buy-in price. Now, as for its income statement, we are going to see that year over year, it's got stability as well, coming in just under $20 billion, while the company maintains a rather clean balance sheet with assets that remain above liabilities by just about $20 billion each year. But this is, as it always does, what it all comes down to, the dividend metrics here, and they're favorable to us, scoring a 91 on Simply Safe Dividends. That's a solid safety score, while coming in with a lower yield at 1.6%. But that means, of course, we're going to get better dividend growth. As we're going to see in a moment, scrolling down, we get a payout ratio at 29%, which allowed for that 51-year dividend streak without any reductions. And best yet, this growing dividend averaging 12% worth of year-over-year dividend growth. Next up, the one stock I'm actually most bullish on after all of the ones I'm mentioning today is TROW Price. That's ticker symbol TROW, which is a global money management firm. And the key takeaway, if you want to be a shareholder of TROW Price, is understanding that their assets are NASDAQ specific. So tech heavy, meaning when the tech sector gets hit, of course, TROW Price then really gets hit. Now, that's important to understand, because as we're going to see, the tech sector has been cooling off over the last 6 months. TROW slid to $108 per share, but we can go about a year out now and see that it performed insanely well with all the AI hype. And clicking to the 5-year view, back in 2021, when tech actually hit some of the highest of highs, TROW Price was there for it, and so was I, telling all of you that you have to have your eyes on it. But I'm bullish on it once again because interest rates are, again, coming down. Now, I might sound like a parrot repeating myself, but you have to understand, lower interest rates are actually going to spur the economy once again, and that's what makes me so bullish on a lot of opportunities that I have for you. However, back to TROW Price and their financials, we're going to see that plenty of revenue pours in year over year in terms of their income statement, but more importantly here, it's their balance sheet with liabilities that remain capped below $2 billion, whereas most impressively, assets just continue to rise. Now, that's a clean balance sheet if I've ever seen one. And with TROW Price, of course, and their dividend, well, it's going to rock your world in terms of that safety score coming coming in at 80, but a dividend yield coming in at a whopping 4.57%. Now, a very feasible payout ratio there for TROW at 58%, while the firm remains 37 years strong in terms of a dividend streak. Now, check this out. We have a growth rate coming in at 14%, and while that dividend is already approaching 5% worth of a dividend yield. Now, investors, there you have them. Another 5 dividend stocks for you to add to your watch list, and again, buy if they're fitting for your portfolio. But now I want to know your thoughts on each of these dividend stocks, which ones you're most likely to buy or bullish on given our macro factors, or if you just have better dividend stocks in mind, let me and the community know down in the comments. Subscribe now and be sure to join me here to learn all of my dividend investing mistakes so you can avoid them.